Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He writes for the Financial Intelligence Report. He's speaking to us from the Bahamas. Welcome back to the show, David.
Yeah, thanks for having me.
David, the U.S. major markets, Canadian markets as well, plunging into the red today. What's behind that?
Well, I think, there's worries now that, there was a couple nights ago, there was some confusion about the trade deal with China. Like, Navarro, who's one of Trump's advisors, said it was off, and then Trump said it was on, and then Navarro said people misquoted him, and then, I think people can see maybe that's not going to happen, especially with the issues you're now going to get, with China and the U.S., because of, everything that happens with the virus and other factors. So that's number one. And then number two, a lot of this was liquidity and momentum driven in the market. Obviously, yeah, we did I think we've seen a bottom in the economy, at least short to intermediate term. Well, because lockdowns, the economy essentially shut down for a month. So, but the problem is because of this rally in the markets, okay, maybe the economy did bottom, but the markets aren't really reflecting the new kind of probably lower growth, lower spending, lower, economic activity area we're going to be in. So, yeah, okay, maybe the economy bottomed, but the markets are so expensive compared to what's going to happen going forward. You could see the economy just kind of maybe bounce off the bottom here or see a W or like an L type recovery, but the markets have to come back down to meet reality. And quickly, I'll give you a quick valuation is that, we're talking about, earnings next year in the U.S. being maybe, 170, 160 in the S&P, and they're going to go down to 100 this year. 100 by the end of the year. Well, that means the S&P is trading at 30 times this year's earnings and, almost 20 times next year's earnings. That's very expensive in a low growth arena. So you may ask yourself, well, why did this happen? Well, first of all the liquidity. On top of the money that the Fed has printed, like the trillions to pay for the debt issuance, the Fed is also loaning money to corporations. We saw the biggest jump ever in one quarter in corporate debt in the United States. And companies are doing that to short-term shore up their balance sheet, and then hoping that the economy turns around. But the issue is, if it doesn't turn around, all you've done is taken on more debt in your balance sheet, right? Even if it is at a low interest rate. And just makes your company more leveraged and more exposed to a downturn. And then also the kind of unintended consequence of these kind of inflated unemployment checks combined with stimulus checks people are getting. Because a lot of people are making more just as much sitting at home doing nothing than they were working. So first of all, that's negative for the economy because there's not a lot of incentive for some people to go back to work, short to intermediate term. And then longer term, and then what do these people do? Well, if you're making the same amount of money, it's and you're sitting at home, you don't have the expenses of commuting, going on a vacation, going to restaurants, etc. Well, a lot of people have just taken the stock market as almost being, like a play event, right? And probably a lot of people, or maybe big sports gamblers, have taken to day trading. You've seen this explosion in Robinhood accounts and this kind of day trading phenomenon, and et cetera. And these people are chasing the hot stocks, chasing those big tech stocks that we all know, Apple, Amazon, Netflix, Facebook, et cetera. And that's this kind of momentum play has started. And what's really amazing to me about it is, the other bubbles that we've seen in history, like the late 20s or 1999 in tech stocks, or even late last year when I noticed a big explosion, the first explosion in retail trading, was you usually have that happening during a booming economy because people kind of believe that the boom's going to go on forever. I guess the subprime housing market and people flipping houses was a sign of that in the States, and even the frothiness of the Canadian housing market the last few years, that usually it's a boom and people think it's going to go on forever. Well, this is happening in the midst of a horrible economy with the highest unemployment rate since the Great Depression. And I think it's just people kind of doing this to fill their time and maybe even try to supplement even more income and not really believing that things are booming or the whatnot. I don't know how anyone would believe anything's booming right now. So it's really an interesting economy. And in a way, to me, it makes it the biggest bubble I've ever seen. And I never thought I'd see anything like 2000 again. When I was living through that, I was a young guy. I was in my early 20s. And I really thought, okay, this is like 1929, and this is what it was like to see shoeshine boys, trade stocks. This is what I'm seeing. And everyone had a tech stock they were in. And I saw these little mining companies that turned into telecom companies, and they went to, like penny stocks to being like $10, $15 companies, and all crashed and went bankrupt. And I really thought that was 99 or 2000. Like was 29, but this is even bigger in a way because we're now seeing this really bad economic downturn and people going crazy over stocks. So, and a lot of them are millennials, a lot of them are new to the market, and I think they're going to learn the hard way about the market in the next 6 to 12 months, when it's obvious there is no economic recovery, when the pace of this money printing is going to continue, but you're not going to see the extreme pace. Like you went to almost no money printing, in the first quarter, to this huge amount in the second quarter when everything blew up because of COVID. And I think they're going to have to come back down. And the last thing on the market, too, another interesting stat showing how overvalued it was. There's an interesting stat showing the top 5 or 6 largest stocks in the S&P and the percentage of the total index that they are. And that really blew up in 2000 when you had Cisco, Oracle, Microsoft, companies like that who were like, the big boys. And they made up this huge percentage and were almost all the gains of the S&P. Well, now we've seen that in, the Amazon, Apple, Google, Facebook, etc. And actually, if you actually take the top 5 or 6 now, they're even a way bigger percentage of the total market than they were in 2000. So it's probably another sign that we're near this economic extreme. And one thing that's really bad about all the lockdowns and everything that's occurred is it's killed a lot of the mom and pop businesses, a lot of the smaller businesses. Whereas, Walmart, Amazon, Apple, all these other things, a lot of these other places were allowed to stay open, right? And almost force people to go into these places, when you couldn't shop anywhere else. So it's been really bad in a way because it's actually made that kind of wealth gap, if you want to call it, even worse, right? It's like, it's made it concentrated. And this is not so much of an individual wealth gap. It's more like just maybe you could say it on corporate basis, where it's even more concentrated in these big companies now.
We'll have more with David Skarica right after this.
Cyprus Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cyprus Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cyprusdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking to David Skarica. David, one of the rating companies, Fitch, has downgraded Canada's AAA rating to AA+, which leaves just Germany as the only AAA rated nation. Is this a big blow to Canada, or was it expected, and will it hurt?
Well, I've been kind of bearish on Canada for a while, and the reason being is what I saw happen, especially with the current administration, is the economy is becoming even more and more dependent on kind of the housing bubble. when oil prices went down, and then with also the regulatory problems with, producing oil in the oil sands, that took away a big part of the economy. And if you go look at it, due to kind of high taxes and a lot of red tape in a lot of areas of the Canadian economy, it was apparent to me that, especially where you are in Vancouver and in southern Ontario, areas such as these that were experiencing this big boom in housing prices, that was really what was driving everything, consumer spending, everything. So now that that's kind of tapering off, it was like, where's the growth going to come from? And then, of course, when COVID hit, they're bailing everybody out. And in fairness, all governments are doing that. And at a time, obviously, when government revenues are going to strengthen and whatnot. So that not really surprised me at all. Now, just because you get downgraded doesn't mean rates are going to go up and whatnot. When the U.S. got downgraded by Moody's a few years ago, well, we're seeing U.S. rates near zero now. So there's an appetite for that debt, especially if people are kind of like big, and I'm talking about big money management, not just us retail investors. There's people who want to get away from risk assets that probably in the short term are going to continue to buy these government bonds. So I don't think in the short term it really means that much. And what's interesting about that phenomenon, though, with them getting downgraded and the States being downgraded years ago, and the same goes with corporations. I think Microsoft is the only AAA corporation left, just like Germany is the only AAA country left. And you would think that with all these low interest rates, there'd be a lot of AAA countries and corporations because, hey, they can handle debt loads with rates this low. But it just shows you that's the problem with low rates. It entices all these companies to take on all this debt. Just think even Apple is not AAA, right? So it does that. And when they take on all that debt, they just become more leveraged. And it's almost like, putting a bunch of drugs or, some coke and marijuana on the table in front of a drug addict, right? The guy's going to go crazy, So that's what's happening. Governments love to spend and borrow. So by doing that, you're kind of almost even more enticing them to spend and borrow. Same with big corporations. And, it's actually wrecked their balance sheets and made them much weaker going forward. And then one thing we got to think about too is, and no one's thinking longer term. Everyone's just kind of thinking now, we got to bail everything out right now, and then in a couple of years, everything will be back to normal. But no, I don't believe that. My opinion is, when you have these high debt levels, usually your economy slows down longer term. All the studies have shown that once your debt goes over 100% of GDP, you get lower longer term economic growth. So the question is, how are we going to pay for this longer term? And I think it'll be a combination of probably some higher taxes and actually just a lot of money printing, trying to print your way out of it, because you can realistically never pay back these debts. And that goes for the U.S., Canada, most of Western Europe, etc. And I think even though it's kind of funny now because you're seeing everything politically maybe move back to the left because the government is bailing everyone out, I think at some point you're going to have this reaction the other way, probably in not right away, like 5 or 10 years, where you're going to have to see austerity and cutting and spending and the whatnot because the governments just can't afford this. Because the perfect example of this, even though Japan has these almost zero rates, their interest expenditures as a percentage of the government spending is almost a fifth of their spending because the debt level is just so high. So these are the issues we're going to run into longer term. And I think what's going on now is just very short term orientated. It's probably politicians trying to get reelected. And the fact that we have this kind of standard of living, most people probably can't afford. And we're trying to kind of keep that going just with debt. And everyone's doing it. Corporations are borrowing, governments are borrowing, individuals are getting these bailouts from the government. You're seeing it at every single level. And I don't know how long it'll last, but I think it really is the end of this kind of fiat money, crony capitalist, I guess you could call it, or kind of system. And the question is just when does this kind of system end, right? When does this end, right? Like in 1929, kind of that ultra laissez-faire, low regulation economy kind of ended with the Great Depression, and then you grew into more of a mixed economy when Roosevelt started the New Deal. And I think now we're seeing the end of this debt-based economy, but this is the transition phase, and that could take a few years.
Will Germany lose their AAA rating? And I recall the 2007-8 recession, Germany's solution was to give people $10,000 to buy a new car. And so they snapped out of it a year later.
Well, and one thing about Germany was, if you go look at that recession, Asia and the emerging world came out of it a lot quicker, especially China. And Germany is such a huge exporter. That's why they came out relatively unscathed. I think one issue with this decline is China is going to be one of the hardest hit countries once the dust settles and the air clears and you see what's going on, because a lot of manufacturing and a lot of business is going to move out of China, and they're not going to, I don't think, have the quick recovery that they did in 2000. And that helped places like Germany and Canada and Australia, because a lot of Chinese money comes into our real estate markets, and Germany because of exports. So, I think the issue with Germany is they're so export orientated, and most of those exports still go to the West and China, and these are all the places hardest hit. I don't think they're going to come out unscathed, and I think they will have some issues, and they'll probably get downgraded as well. The positive thing that Germany has going for it is they don't have this bubble-based economy that, based on they didn't have a huge housing boom like Australia or Canada or the States or, people piling into the stock market. They're much more of a production, like I said, export-based economy. So that's the positive. But the negative is with these Western countries and China, probably the consumption is going to be down for a number of years. That will, in the end, also hurt Germany. And I think they will lose their rating, but they're going to lose it probably at a much slower pace than some of the other Western worlds. Like, for example, we're talking about Canada losing it now. The U.S. is probably going to be, if it wasn't the reserve currency, they'd be in huge problem. That's why they're doing what they're doing. Their debt, the deficit as a percentage of GDP, is going to be bigger than anyone this year, way bigger than any of the Western European countries or Canada, etc. So, and if, I don't like to get in politics, but if politically they do this far shift to the left, and, the Democrats are way more left than they were under Obama or Clinton, I don't think foreign bond investors are going to want to buy U.S. bonds or keep the bonds, keep buying bonds just because the U.S. is the reserve currency to pay for all these politicians' ambitions. So that's another thing to watch, and that's longer term politically.
We'll have more with David Skarica right after this.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, where does gold and silver fit into all this?
Well, they're down a bit today with the market, but they've had good runs. Gold is back. Gold's right near, if you go look at that rally that first happened off the lows of the COVID crisis, the intraday high on the cash and gold is about 1775. We got up to about 1770 on this rally on the cash. So I think we're just right at the resistance right now, and if that breaks to the upside, we're going to see it go to 1900 and beyond. And I think maybe the catalyst will be when the market starts to roll over again. I think Trump has already said it's going to happen. There might be another stimulus package. So again, that's more trillions of dollars poured onto the debt, and I think that could act as another catalyst to gold, to the upside, kind of on the next move higher. And remember, like we were saying, all these millennial and all these day traders are pumping into the market, going into growth stocks and tech stocks and whatnot. Well, let's say these people start to lose money in the market, and they essentially, but they still decide to stick around. Well, I think a lot of them, when they see gold and silver being the sectors that really are holding up, they may start to move into that sector, and then we may see gold and silver benefit from these smaller kind of day traders and the whatnot. So I think, yeah, fiscally you're already set up. Like I said, we're kind of, we're overbought in the short term. We could see a little correction here, but I think we're really kind of set up for some kind of move in the second half of the year, probably back to the all-time highs and maybe over to 2000, between now and the end of the year, and then much higher in a year or two. Because I think right now, again, maybe what's holding gold back, it's not some conspiracy theory and people, banks selling and the whatnot. I think it just might be this mentality still that all this is short term because of COVID. But if I'm right and we come out of this with a much weaker, slower growth economy or no growth economy, and these debts and deficits are still huge, that's when gold really goes higher. Because what people have to understand, the big difference between this and the Great Depression was, in the Great Depression, both the U.S. and Canada did spend money. The governments did try to, buffer the economy. But the debt levels in the U.S. and Canada were almost nothing in 1929. We're talking 10, 15% of GDP. Now they were like 100% of GDP going into this. So they just don't have the resources to really, after this initial wave, kind of bail everybody out.
David, how do you think energy is going to do?
I think, energy, I only bought one or two small positions on that decline in March, the day that oil went infamously negative. But I think the problem is you still have to see the write-down. We still have to see projects really close down en masse, a lot of layoffs in the sector. And my opinion is that will take 6 to 12 months to kind of sort out. And because, like I said, the global economy is still kind of in this kind of no growth or negative growth recessionary mode, I think that's negative for oil off these highs. I think, the actual cash on, or futures low wasn't really negative. It was like about $15 a barrel. And, it's rallied back to 40. So I think we could go back into the low 20s, and that might be the final nail in the coffin for a lot of these, fringe producers, smaller producers that can't handle the low prices. And that, I think, would happen by the fall. And then I think after that, you could see oil do really well. 'Cause I don't think a lot of this fracking stuff will ever come back online. I've always thought that was a bubble. That's a financing scheme, as Jim Chanos, the famous short seller, would say. It was just companies always borrowing money to continually drill, and then they were never really cash flow positive, et cetera. So that 13, 14 million barrels a day the U.S. is producing, I'm pretty sure will be halved by the time this is all done, and it won't really come back for a number of years. So I think when that happens and you've got all that supply off the market with a recovering economy, and if I'm right, Asia will come out of this much stronger, and you will see demand for oil and gas out of that. You could easily see oil, go back to 50, 60, 70, especially if the Saudis and the Russians are slow to put production back on the market, because they're going to be the ones kind of benefiting from that as well. And, then we got this whole thing with Egypt and Libya, and, I'm not a conspiracy theorist type, but I do find it interesting that, like, for example, Saudis are on Egypt's side, and Libya had just started to put a lot of oil, back and onto the market, which hadn't been there for a number of years. Well, what happens if they go to war with those two countries, and then all of a sudden Libya's got to use that oil, for their army, or they just, Egypt bombs their oil fields or something like that. That again, that kind of benefits the Russians and the Saudis. So I really think, like I said, there'll be another wave down. That's when you're going to see bankruptcies, write-downs, layoffs in the sector. I think that is the time to buy. And it's going to be a great buy, by the way. I think it'll be one of the best. Like it'll be like 1998 in oil. It'll be a fantastic oil buying opportunity.
David, thank you so much for chatting with us.
Thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He writes for the Financial Intelligence Report. If you have any questions for David or any of our other guests, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.